Hello, everybody. Richard C. Wilson at the Family Office Club, and welcome to our show. We have here with us today George Hall from Exchange Place, and I'm excited to have him here because most people do not focus on deal structures enough. And from the very first interaction, George pointed out what they're doing, how he structures deals differently. We're going to go into that within this interview. George has his MBA from Wharton. He was also CEO of a $10 billion hedge fund, and his experience in trading and working at a multi-billion dollar hedge fund, I think, brings a real unique perspective. So he's going to explain a bit about his current thoughts on where the market is with alternative investments and structured notes, and comment on some trends in the industry. And I think it's going to be great. So thank you for being here, George.
My pleasure. Thank you for having me.
What else would you add to your bio and background, and then a bit on Exchange Place, just so everybody knows kind of what perspective you have?
So over the years, the hedge fund Clinton Group, a lot of people are familiar with it. We did lots of different things, starting out with mortgage-backed securities primarily, and then we gravitated into lots of different areas, including stat arb and shareholder activism. So, we had a pretty broad base. But, my mortgage background always sticks with me. So there's not a cash flow I don't want to try to securitize or restructure and find a better home for it. So that's a lot of what I'm interested in today. In terms of Exchange Place, one of the things that's kind of fascinated me is some of the opportunities post the Job Act, specifically things like Reg CF and some of the changes with Reg D and Reg A. Specifically Rule 506C. I don't want to get overly technical, but
Sure.
basically we're now allowed to advertise investment opportunities. And that was, you aren't able to do that. So for years and years, I used to travel around the world talking to LPs. Now, actually, you can put a lot of information on a platform or a website, and people can just come on and see it. So we've seen some firms that have been tremendously successful, Masterworks, Yield Street, iCapital, but I think we're still in the early innings of this evolution. So I'm pretty fascinated by it.
Right. Yeah, for sure. It's a massive change. And, the Reg CF is obviously related to crowdfunding, but, what I see is that it's really opening up alternatives to many types of investors. But we have some doctors, some dentists, some people that grew their steel fabrication business and just had an exit. They may not be familiar at all with what an alternative investment even is. So could we back up a little bit just to alternatives and whether this is like a new trend, or is that already a really big industry, and just kind of give an example of what an alternative investment is at a basic level?
Sure. So I think people consider the basic investments to be stocks and bonds and some portfolio of stocks and bonds. So I think the name alternatives generally applies to things like private equity and venture capital and certain real estate investments, as well as hedge funds. So this was generally, investment categories that were restricted either through information or through regulation to institutional investors or very high net worth investors. But over time, they've become more generally accepted, and they're in virtually all institutional portfolios, and now they're more available to lots of different types of investors.
Sure. Yeah, I saw one statistic that I think Yale has over a 50% allocation to alternatives. I thought that was super interesting. And, a lot of people look to the largest endowment funds that employ some of the smartest minds, because their portfolios are much more public than a family office portfolio that may employ similar quality investment brains, but, it's just far less public. It's fascinating to me that most people have heard of the word private equity or venture capital. To some degree, investors have heard of alternative investments less, and the word family offices less. But the alternative space and family offices are both, 14 and $22 trillion spaces that are massive. And it's really about democratizing the access to these spaces is what those regulations were all about. And so I guess what you're doing is spending your energy on helping expedite that inevitable process of giving high net worth investors, family offices, access to alternatives in a way you couldn't do just, 7 years ago or so, right?
Yeah, and there's a few aspects to that. There's also the other side. But this creates opportunities for issuers to raise capital more easily. So, we've heard of, I'm sure there's many, many companies that would have been great companies if not for the inability to raise capital. So here we provide other avenues, and other investors can look at different opportunities, and they can vote with their checkbook, and if they want to invest. So hopefully it'll create more efficient markets for corporations and funds to raise capital, and then also provide
Right.
investment opportunities that weren't generally available.
Sure. Yeah. Interesting. I know the CEO of IBM at one point said there were some people within IBM that didn't have to follow the rules. They would come up with new divisions, new products. They could do almost whatever they want and had extra budgets to do it. And all the innovation came from those 7 to 10 people out of 1,000 employees at IBM. And then what I've heard is that Silicon Valley people now say, well, now there's private equity and venture capital. So those people now would leave an IBM, get funded by private equity and venture capital, go out and create massive wealth and create unicorn billion-dollar companies. But then family offices came around, and now they're providing some hard money lending, they're funding ideas. And then this is just the next step of democratization and making it so there's more options for entrepreneurs. If you don't want to go to private equity venture capital, you could do family offices or crowdfunding or a platform such as Exchange Place. And it's just part of that evolution of you used to be stuck inside a huge corporation and hopefully get anointed as one of the people that would get funded by IBM. And now there's all these options available, right?
Yeah, I would also say, I'd point out though, I think you said they don't have to obey the rules. I assume those are IBM rules, but the SEC rules and FINRA rules we have to obey.
Right,
Uh,
right, right.
but yeah, I think the regulations are moving in that direction and making it more open, and I think that's the response to people's desire to have these types of investments. So I think hopefully at Exchange Place we can help some issuers raise capital. We can create some new investment classes that don't really exist yet, and
Sure.
hopefully there are things that may be important to individuals that institutions don't care about. If you're a sports fan, or if you're a movie fan, or if you like
Right.
other types of assets, there may be a little additional value you get out of something in terms of personal interest and entertainment that an institution may not get. So I think there's lots of
Hmm.
opportunities for creating good products for people.
Right, right. Are you saying that like somebody might be a Chiefs fan and they want to own part of the Chiefs, or they want to invest in a royalty on a Taylor Swift song, or like something like that, like a personal affiliation passion project? Or are you saying that there's the unique upside returns that maybe the investment banks maybe overlook because it's not a traditional marketplace?
I think part of it is it'll be overlooked
Okay.
because the institutions tend to kind of follow tried and true strategies.
Sure.
But if you if a quantitative analyst did an analysis of the Kansas City Chiefs valuation versus Taylor Swift's catalog valuation, they'd come up with a number. But if you're a Taylor Swift fan, it might be worth a little more to you. Or if you're a Chiefs fan, it might be worth a little more to you. So,
Right.
there's kind of a fair economic price in some theoretical sense, but then there's also, call it the emotional additional value that people get.
Right. Yeah, that makes sense. I mean, just like in the markets, someone might have a economic value and a target price for Costco, but if you've been a Costco customer for 15 years and you just know how they buy and the quality of it, and you believe in the mission, you might know it just as good or better than the analyst in terms of a customer development perspective. So, might have a totally different opinion on that value long term and where they're going to go. So, if we get a little bit more technical, though, some of your background is securitization of assets, structuring notes, and I think you said the last time we interacted that there was over $130 billion of structured notes that get put out each year by banks. Can you define exactly what a structured note is, and then how that relates to what you're structuring onto Exchange Place?
Yeah, so structured notes are generally considered to be issued by banks with some type of guarantee of principal. and then some upside or additional return based on the performance of an underlying asset, whether it's the stock market or some commodity or something else. So if you break that down into its components, it really looks to me like it's a zero coupon bond on the issuing bank. And then there's a discount, and that discount is spent on stocks or commodities or whatever the other asset is. Now, it's hard to get a great return when you have a zero coupon on a high credit bank as well as some riskier asset like the stock market, but the blended return on the whole piece may not be exactly what people are looking for. So there's lots of bells and whistles that get added, but it really is similar to a stock and bond portfolio that's just combined into one security. And
Got it.
right, so part of it is fixed income, call it the issuing bank's credit, and then part of it is equity or commodities or something like that. So I think it's a good product. There's clearly a lot of interest in it.
Sure.
There's a lot of mixed views on them. I think a lot of people would argue that they're too expensive and they too sometimes enhance the yield. They put in embedded options that may not necessarily be fairly priced or accurately priced for investors.
Sure.
But it's a self-contained entity with kind of a band of returns, which there's a place for it. So back to what we're thinking about doing, or what we're going to try to do. We're not an issuing bank, so we don't have a AA or a AAA credit rating. But an alternative way to do that, and I think a potentially better way, is to buy zero coupon treasury bonds and put that together with a risk asset. And if you think of that in terms of being some bonds and some stocks, the classic 60-40 portfolio is, I think kind of a very simplistic way to approach things. But basically, the bonds are supposed to offset and be somewhat uncorrelated to the stocks. I think if you're going to take that approach, treasury bonds are actually a better place to be, because if the stock market does have a big downfall, generally the flight to quality helps the treasury bonds. So we're creating a series of notes or funds, if you will, that will have investments in zero coupon treasury bonds to try to assure investors that they'll get their principal back. There are some exceptions, like the custodian bank fails or some other, very limited risk, but then put it with a risk asset, and then hopefully the blended return will be something that investors will be happy with.
Yeah, interesting. There's a huge interest in credit and income investments. There always has been with private investors, but with interest rates, having gone up recently, we see a huge interest inside of our investor club. But even after doing this for 18 years, maybe we see a lot of hard money lenders that come through our investor club and credit funds in general, but very few people that have decades of structured note experience and can talk to that and have the type of experience you have. So that's one of the things that makes running Family Office Club interesting. It's kind of like a perpetual learning machine when we're hear from 75 speakers on stage, and one of them was talking about how they structure notes and a unique way to combine treasuries with an underlying equity asset. I don't think anyone has said that in 18 years since we started our investor club, that's the approach they're taking. So super interesting. What do you think is the number one thing when you meet with an investor, like you meet with a large family office and maybe you're setting up a custom structured note for them, or you're designing something like this? What do you think is the number one kind of misconception or the point that you would want to make sure they understand about this that might easily be confused if somebody's hearing this for the first time?
Well, there's sometimes a cynical reaction. Well, why do I need you to buy treasury bonds? I'm like, well, you really don't need me to, but you should keep something separate that is, fixed income or zero coupon to offset the risk of the other assets. So, if you think of people that have, I'll use it as a general term, which you understand, 60-40 stocks and bonds, there's what I'll call a blender of stocks and ETFs and maybe private equity and venture capital. And then there's a very different bucket of bonds and potentially different bond managers and so forth. I think there's rarely a situation where people are comparing the underlying stocks to the underlying bond portfolio and looking at, correlations of actual assets. There's kind of a simple approach that stocks and bonds are generally not correlated, and overall you'll be fine. But the
Right.
node idea is to basically take something that's equity-like and put that together with part of your bonds, but put it in a self-contained unit where the taxes can be managed together, the maturity of the portfolio can be managed. So, I think there's some advantage to putting them together in an entity, but some people, need to see that there's benefit to putting them together.
Right, right. Got it. Okay. And then what about, we had mentioned last time we spoke about fund management fees, kind of your unique opinion on that space. So what would be your comments on that, on like where the industry is at? You've been in the hedge fund space before this for so long. You're obviously not new to seeing the alternative investment levels of fees that are normally charged.
Well, people that are advising or gatekeepers, obviously they want to play a role that they think helps their investors. But
Sure.
maybe I'll ask you a rhetorical question. Maybe I'll answer it. You tell me if I'm wrong. If you said, who are the most coveted funds that are hard to get access to, that everybody wants to get into? Names that might come to mind are Citadel or Millennium or Point 72. The
Right.
fees, as I understand it, well, fees and expenses are actually extraordinary compared to 2 and 20. And I think
Right.
that's not necessarily a bad thing, because you want them to be able to have what money they need available through expenses and fees to do what they need to do to manage the money properly. So I think at times squeezing managers, particularly young managers that are kind of, anxious and desperate to get money, sometimes squeezing the fees actually can be a little bit counterproductive. Now, that being said, the folks that I mentioned, they've got years and years of demonstrating success and, using those fees and expenses properly to generate returns. But, I think it's kind of classic of a lot of gatekeepers say, I want to, try to negotiate lower fees. I'm not sure that's really in their interest. They should look at the
Right.
strategy, and they should look at what it costs to run the strategy and let the fees and expenses fall out of that.
Right. Got it. Yeah, makes sense. Is what you're doing related to the whole trend of fractionalization or tokenization, or are you completely different and not related to that whole trend as well?
No, I think fractionalization is 95% of our goal here. So we've
Okay.
set a number of funds that we're going to actively start to raise capital for. And the goal is to purchase assets, because if you have capital available and you can purchase assets, you're in a stronger negotiating point. We buy assets. And then the goal is to fractionalize them and distribute them in smaller pieces to the public, maybe some structuring value add in between. And it's silly, but probably the best analogy is you can go to the supermarket and you can see a rack of whole melons, and then you could see the cut up fruit in smaller pieces. And the reality is they charge a higher price for the smaller pieces because there's some value add there. So I think fractionalization is important. And the goal of pretty much our whole business now is taking assets, fractionalizing them, and making them available to the public.
Got it. Yeah. So as I'm thinking this all over after hearing everything you've said, I go back to the beginning part of the examples of like the Chiefs, or let's say part of a Red Bull F1 team or something, where there's so many fans, and that fan base is part of this, like finding something that's completely different than what most people get pitched. It's not even a normal alternative investment. It's like an alternative to the normal alternatives, and kind of finding a combination of that good return structured with the treasury. So you got the 80% treasury, maybe potentially, and the 20% exposure to the equity deal, and then leveraging the excitement around, how many Red Bull F1 jackets do you see at an F1 race? I mean, it's like 70% of the crowd, at least before McLaren started doing better. I don't know what the color of the fan base looks like these days in terms of orange versus blue and red, but is that some of what you're doing here? Is basically on a very high level looking at, like, people might want to say, I own part of a Picasso, and then giving them that, and it's not only exciting, it also is just uniquely structured, and it's also an alternative to normal alternatives.
Well, I think there's two important things to consider there.
Yeah.
You sell something, not necessarily a Picasso, but let's say an F1 team or a NASCAR team or a a professional lacrosse team, something like that. When
Right.
people have ownership, they become extraordinarily devoted to that asset.
Right.
And in some sense, by having, rather than having one sports fan invest or one venture capital company invest, if you could fractionalize and sell to thousands of investors, you've really got thousands of brand ambassadors and thousands of fans and thousands of people
Right.
that believe in it. So I think there's some real value to that. So you're letting the investors become the customer, or letting the potential customers of the asset be the investors, I think actually helps the
Right.
success of the stock. Think about a movie. This constantly producers are running around trying to find wealthy people to invest in independent films. But if you could have a fractionalized film, everybody that invests is going to be a fan. They're going to tell their friends, and that brand ambassadorship actually can help the success of the asset. And the other aspect
Hmm.
that's important is, with all the material that we can provide with technology and platforms and so forth, videos and written material, it's almost like test marketing. If there's an audience of thousands of investors that want to take a fractional piece of something, it's a pretty good indication that it appeals to the masses, as opposed to
Sure.
one investor and one producer in the movie case saying, I think this will be good if we can make it, right? So, and that's
Right. Right.
all kinds of sports assets where there's a fan base. So I think
Hmm.
letting consumers become investors actually provides advantages to both sides.
Yeah, super interesting. Robert Cialdini is like the godfather of influence and persuasion, and we got to interview him last year. And he showed in one of his books that if somebody just bets $1 on a horse at a horse race, it's scientifically proven that they're going to say a bunch of good things about that horse, and they're very confident that that horse is going to win, and they'll tell everybody about it. And it's just a natural human psychology that after you've placed your bets, it's like a sunk cost. And now you form all these positive associations with it. You're more likely to go to an F1 race now that you say, oh, by the way, you might not know that I own part of the Red Bull team, by the way. Or, you know what I mean? Like, you can say it in a classy way. It doesn't sound strange, but like, I think that's something that Cialdini talks about often. Super interesting. My other question
Wait,
was
if I
about,
may, if I may, I sorry to interrupt,
yeah,
but since you brought up a
no,
horse, I have to bring a little analogy here.
yeah,
We actually did fractionalize a portion of a racehorse, and people that bought just a few $100s worth of the horse went to Saratoga. They were in the winner's circle. It was the time of their life. Other people actually, invested $500, but flew to California and spent a week to watch the horse in the race. So what to me that demonstrated is, even a small economic ownership provides, an ecosystem around merchandise and travel and
right.
sport. So I'm pretty enthusiastic about trying to bring other ownership opportunities to people, to not only make them some money, hopefully, but also to give them the enjoyment of something more fun than a corporate bond or a stock.
Yeah, for sure. On a very simple level, I could see even something as simple as a local pizza restaurant opening. You know, restaurants are thought of as a more risky investment on planet Earth, obviously, but just for a simple example, and if someone maybe gets special ownership privileges when they go there for half off drinks or half off pizzas, they might tell everybody about it and go there 100 times, you know? So yeah, it's interesting. I know both of us have focused on deal structure, and a lot of your success has come from navigating the structuring of deals and adding value to investors in that way. I love thinking about that area. You know, I'm curious, out of all the deals you've structured and put together, do you have like a number one insight or best practice or a place that your brain goes anytime you look at a deal and you're analyzing it on how to structure? Do you automatically look at how do I protect my downside, or do you automatically look at pairing various assets together, or any tips or strategies just for other family offices listening who also are trying to move up that learning curve on how to structure deals, and be more agile with how they approach custom structures?
So I think, assets all have a certain amount of risk, and some assets may be worthless, or they could be worth, 10x, and people can make that investment if they choose. If they want to collar that return and decrease the downside, and maybe give up some upside, they can tailor it. There's a lot of interesting things that when I see them, I immediately think they can be structured into a security. So,
Right.
we're aware, going back to probably David Bowie gets credit for one of the first ones where he securitized, or some of his catalog and his future earnings. And now, musicians do that more frequently. There are private equity funds that purchase musician royalties and so forth.
Hmm.
That can be done. It's all part of the evolution of securitization, going back to the original Ginnie Maes and Fannie Maes to securitizing mortgages. Um,
Right.
Things like athletes' contracts or the earnings of a sports team can be securitized. Virtually any asset can be securitized, as just got to fit within the appropriate regulations. So when you
Sure.
securitize something, you enhance the liquidity, you enhance the tradability. And, I just think it's part of an evolution of securitizing as much as possible, which helps mutualize risk and allows people to have more liquidity in their portfolios.
Right. It seems like there's a class of people that are really good at thinking that way. I think it's a muscle I'm trying to build. But when you approach a real estate deal, if you can separate the land from the building and sell off the building and have the land long term and lower your basis to almost nothing or sometimes nothing and keep that income, it's just another really simple version or example of how you can create wealth through custom deal structures or securitization or structured notes, however, whatever keyword phrase you want to use for your industry or space, right?
Yeah, it's really all sum of the parts. Things can be broken down. My guess is a lot of the people that buy structured notes don't necessarily think of it in terms of a zero coupon and some other options embedded. But when you break it down into the components, it also helps with valuation, because you can look at the options market and use that to put a value on a structured note or some other type of security. So breaking
Sure.
things down into parts is part of the way we get to proper pricing for assets.
Sure. Yeah, it makes sense. Anything that I should have asked you and I haven't yet, do you want to include in the interview?
No, I hope I said a few interesting things. And of course, I'm always happy to talk to any family offices that want a little more detail on some of these things, or any of your club. I'd be happy to talk to people. But I think the thing that struck me when I looked through a lot of your presentations was, I think it was structure trump strategy, and I think that's
Yeah.
absolutely true. And if you look at venture capital portfolios, I don't want to quote numbers that I haven't verified, but I think most
Sure.
people agree that a good portion of even the best venture capital funds, a good portion of deals may go bust. So, they're relying on putting a portfolio together, and hopefully two or three, and power law determines what they can ultimately make. So, every asset has risk, and you
Right.
can break these down and then put them in a portfolio or merge them with other assets and try to create a return profile that works.
Right. Yeah, no, makes sense. I always like give the example of you could have an amazing looking opportunity, but you could structure it so it's horrible for the investor, right? They could get no collateral, they could get no income, they could get paid last, they could have capped at a 1.1x return, or you could take a pretty boring deal. But if the investor has all the collateral, gets all the income first, and gets a 3x return before the issuer gets anything, then it could be an amazing deal potentially, right? And so that's just an extreme example. But I find that many investors may negotiate a little bit on fees. That's where their brain goes, but they almost never negotiate the structure. And that some of the smartest centimillionaire families I know, and people like yourself from the hedge fund world, which is the space we initially created our investor club in, structuring the deals is at the core, and it's like near and dear to your heart because it's partially what's made you into how successful you are today, and your background running a $10 billion hedge fund, right? So it's so core. So to wrap things up, can you remind listeners the industries and asset classes that you want to be getting access to deal flow in, or that you are going to be building out on Exchange Place so they can keep you in mind for those types of opportunities? And then also, where's the best place to go on the internet to learn more about you, or what's your best email or phone number so they could reach out directly if they wanted to do business in some way with you?
All right. So the areas that we want to focus on securitizing assets is sports, entertainment, real estate, art, and then other alternative investments that may not be available on typical platforms. We want to make those available, things that we've due diligence, we feel comfortable with, and to provide access. So those are the asset classes we're interested in. And the site is up, exchangeplace.io. A lot of our assets are, we're getting close to what I'll call a big launch. So we'll see a lot more assets in the next few weeks on the platform. But I can always be reached at george.hall@exchangeplace.io. Happy to talk to more people and go into more detail on any one of these topics. But, we all know that private equity firms and a lot of wealthy people are making a lot of money in sports, and there's also ways to help smaller investors make some money on sports, and same thing with entertainment and other types of interesting assets.
Sure. Yeah, makes a lot of sense. And if anyone's a member of our club or an investor friend of mine and they want to get access and chat with George directly, just let me know and I'll connect you over email. I appreciate you doing this member spotlight interview. And, just like anyone you meet at a 700-person investor summit we host or a little 75-person AI workshop, we always encourage anything you hear in a podcast to conduct full due diligence. As George says, anything in the world has risk, and we try to say that in all of our webinars and all of our events. But I appreciate you being here, George, and looking forward to seeing you maybe in Beverly Hills or maybe at our Fort Lauderdale summit coming up. And appreciate you spending the time with me here today.
Great. Thank you. I hope it was interesting to some people. So I appreciate the opportunity.
Sure. Thank you.